Welcome to Block Time, powered by Riot, our podcast about all things Bitcoin, Bitcoin mining, and anything else that comes to mind as we discuss. We've got a very special guest today, two special guests, actually. My wife, Morgen Rochard.
Thanks for having me.
And Preston Pysh.
Hey, welcome.
Thanks for coming into the studio, Preston. We've got a big Bitcoin conference going on here in Austin, BitBlock Boom, which have you been to before?
I was here 2 years ago.
Okay.
2 years ago, yeah.
I think that was the COVID conference.
Oh, yeah, it was.
And I went to the first one that was in Dallas. That must have been 3 years ago or
that
4.
That was 2018 because I went with you the next year in 2019.
5 years ago?
Yeah.
Well, yeah, put on by the great Gary Leland.
Yes.
Let's start by having Morgen introduce herself, kind of what your background is. And
yeah, sure. I could do that. Other than being the wife to Pierre Rochard.
Big responsibility right there.
Which is, a mother to 3 children.
Yeah.
I have a financial planning practice. My practice is a registered investment advisor located in Texas. My firm is 9 years old now. And I predominantly work with Bitcoiners, which, contrary to popular belief, Bitcoiners actually do need financial planning.
That's true. They're in denial about it. Let's hear your background. Everyone already knows Preston, but for those who don't.
Started off military, flew. I have an undergrad in engineering, aerospace engineering, and found myself becoming a podcaster by accident. I just enjoyed talking about finance, and here I am, still doing it. Blessed to have people that tune in and listen to some of the stuff that we put out there. So
before we started the episode, we were talking about a tweet from Morgen. Morgen, do you want to tell us what the tweet was?
I like this.
Yeah, my tweet was that if you overallocate to Bitcoin, you end up with less Bitcoin.
Which is, tell us what overallocating means.
Yeah, so I think that people misunderstood this tweet because most people read it and they thought, oh, just another Fiat shill telling me that I'm not supposed to have any Bitcoin in my portfolio. But that's not actually what overallocating means. So overallocating is really more of a fine art, I would say, than a science. And there's no set percentage or prescription for any one person as to how much Bitcoin they should or should not have in their portfolio. I believe as a financial planner and a proponent of Bitcoin that everyone should have at least 1 to 3% of their portfolio in Bitcoin. I like starting positions of at least 3%. And so that's obviously on the low end. But if you're the kind of person who has really regular income and a reasonable emergency fund, and your life's pretty stable and you have a really high risk tolerance, then I don't really see any problem with 100% Bitcoin allocation. That wouldn't be over allocating. The issue would be if you didn't have that emergency reserve, you had very irregular income, you got paid, a lump sum early in the year, and then we're waiting for maybe getting paid later in the year or so forth. I see that happen with people sometimes with commissions and so forth. And then what happens is that maybe they didn't pay their taxes in, and they bought all of the Bitcoin when they got their big lump sum payment. And then coming towards the end of the year, they realized they didn't pay in, and now they're selling at a loss. And that's what it means to overallocate. If you overallocate, you will end up with less because you will be forced to sell when the time comes.
So basically, like, people's allocation, how much Bitcoin they are going to, accumulate, is just different based on their circumstances.
Yeah, absolutely. And so I often hear people want to know what's the rule of thumb. They want that 60-40 style portfolio for Bitcoin. They want somebody like me to create that and make that be the rule. And it's just one of those things that it can't be. And the reason why is because it's not actually an investment. You're talking about savings. So it's how much savings do you need to have and how much long-term savings do you need to have? And that's very different than how much short-term savings that you need to have. And when you're thinking about savings, it's a very different story than, okay, I have a bunch of investable assets I've already set aside for investing. How much of that should I allocate to stocks versus bonds or real estate or whatever else you're looking at?
Yeah.
Yeah, I would just add, in addition to all of that, what I completely agree with, when people when it finally clicks for them and they start to understand it, they get really excited, and they have this tendency to say, oh, I need to buy as much of this as possible. And because it's very volatile, sometimes they'll buy and it swings 30% in a very short period of time. And then they're like, oh my God, I'm just going to throw everything I've got at this thing, because they think that volatility is just going to keep running, and they get very emotional about it. And so I think it's that, combined with, I think a lot of people aren't realistic with what they're able to actually retain and what their disposable income actually is in a given year. And so a lot of these factors are why you see a lot of people over allocate, and then they're forced into a selling position because they over allocated, and it just kind of ends in this emotional kind of disaster for a lot of them, because they're not being realistic with their understanding of where they're at in the timeline, just the natural volatility of Bitcoin, and just really kind of all those factors kind of combined together just really makes it hard for a lot of folks that just aren't being realistic with themselves.
Yeah, absolutely. I mean, Bitcoin is it's a long-term asset. It can never, ever be used for short-term purchases.
Mm-hmm.
And so, and I don't necessarily think that means in the future we can't use it, to go buy your coffee or do whatever you want to do in the future, right? But when you're thinking about large fixed expenses, it's not the right thing. If you want to go buy a house in 1 to 3 years, saving in Bitcoin is not going to be right for you, because you might not be able to make it through a cycle, right? In one case, you could be buying at the top, selling at the bottom, and then going to buy much less house. Tax bills come to mind, where people, they don't necessarily allocate properly throughout the year for their taxes, and then taxes are due April 15th, and they realize, hey, I have to sell my stack now because I over allocated. Having any kind of short-term goals. So, I mean, this has come up for one of our clients where he wasn't sure whether or not he wanted to buy this business, and then he decided he wasn't going to buy the business and decided to allocate to Bitcoin instead, and then decided later, after we had already allocated to Bitcoin, no, actually, this business is something that I want to buy, right? So if you're sort of one of these people where you change your mind about things, and you change your mind about large expenses that are coming down the pike, or large major life decisions, then you really need to keep more in fiat to basically enable yourself to be able to do the things in your life that you want to do, since we don't live in a Bitcoin standard right now.
And that's the other point, is they're not realistic with their the volatility that they induce in their own life. So a lot of entrepreneurs, they might need 500K in order to buy or get their foot in the door in a business that they're looking at. And the environmental factors change, and it's, well, I didn't like it 6 months ago, but now I do, and I wish I wouldn't have done that. And they're just not being realistic in their own decision volatility that they have in their life. So, I tell people this all the time. You do not need a massive position size for this to have a large impact in your life long term. Where it's priced right now versus where I think it has the potential to go in the coming 5 to 15 years or whatever, like your guidance of 1 to 3% is more than enough to protect whatever net worth you have. And I would tell people, any multiple over that, as long as you can withstand the volatility on a long time horizon, is just going to be, in at least in my opinion, a multiple of whatever your net worth is today. And I'm assuming 1% would pretty much protect your net worth. 1 to 3% would protect your net worth. So you allocate 5% or 6%, like you're going to have a multiple of that with your net worth in enough time.
I think there was a research report. He was Meester. Do you remember this one where the page that was most clicked on was early retirement? Because he was recommending allocations for people, and the insurance allocation basically was that, I think it was 1 to 5% or somewhere in that range. And then the, accumulating wealth one was between 5 and 10% or 5 and 15%, something like that. Yeah. And then his early retirement one was, okay, it's speculative. You might not actually be able to retire early, but if you do this, if you allocate, 15+% of your portfolio, then, you're retiring in 5 years or whatever it was. And so obviously it depends on how much you're starting with and how much you're allocating and so forth, whether or not those numbers will pan out. But I think it's sort of like, if you want to look at it from a rule of thumb standpoint, just like you were saying, like each multiple or each percentage that you add is going to add multiples of protection to your portfolio to hedge against inflation. And then obviously then some. And I think honestly, what it comes down to when we talk to clients is like, how much do you really need, right? In a lifetime. And so,
Yes.
like, what are you trying to use this money for? And if you don't have these, crazy aspirations, for most people, just taking a reasonable position, it's going to make them feel comfortable at night. They're going to be able to sleep well. Their
Yeah.
spouse is going to be able to sleep well, as long as you're, protecting it in the ways that you should, like storing it properly, making sure your spouse knows how it's stored. I mean, we often see this with couples where, and I see this on Twitter all the time, where the husband, sort of drags the wife along on the
Or vice
Bitcoin ride,
versa,
or vice
or vice
versa.
versa.
Yeah.
Yeah.
It's usually one way. And they're like, she'll thank me later. And it's like, okay, but along the way, like, why do you need to, to
Yeah.
argue with her for the next 10 years until then do you really want to be in that situation in 10 years from now where she's like, I told you so to your wife? Like, is that really good for your relationship? Like, do it together, get on the same page. And maybe that means that you allocate a little less at the beginning until you fully orange pilled her and so forth. But yeah.
I think that's a super important point, because if you ask somebody, well, like, what is your end state financially as far as like a goal? Some people will just answer that and say, well, it's just as much money as I could possibly make. And it's like, okay, well, why? Like, what is it that you're financially trying to achieve? And if it's some ridiculous number, you have to really ask yourself, like, why? And then probably ask yourself why another 4 or 5 times to get at the root of maybe an insecurity that's trying to drive you down a path that's just, not reasonable, or I don't know the right word, but when you do define what that goal is financially, all of a sudden you can start acting a whole lot more appropriate today in order to achieve what that is, as opposed to this unbound, unlimited, I want billions, right? Like, that's just, you're setting yourself up for turbulence and sleepless nights, because you're trying to achieve something that is somewhat absurd. So I think that's really important for people to sit down, be realistic, and define, where are you sailing? Where's that destination going to? And then let's backwards engineer, like, what an appropriate response is as far as allocation of disposable income to try to achieve something like that.
Yeah, definitely.
So we were talking about, like, in a context of like personal finance of like individuals and couples. I think the same principles can apply from a corporate perspective. And I would argue, Elon Musk buying Bitcoin and then selling it, although there was mixed reporting about that. I still haven't got to the bottom of what he sold and how much and when. But to me, that just indicates that he overallocated because he sold so soon after having bought.
Oh, absolutely. I mean, if you understand that Bitcoin is long-term savings, then you don't allocate a portion of your company's balance sheet basically to an asset where you're going to need it to meet short-term operating cash flow needs. I
Yep.
mean, that's just kind of basic. He wouldn't have done that he wouldn't have bought stocks with that. So I don't know why he thought the same thing with Bitcoin.
So this was probably, when did he allocate? 2 years ago?
Yeah.
Was it?
Is it that?
Yeah, 2 years ago. Like, it might have been the week that this was announced. I was doing a recording with Pomp, and I told him, I said, honestly, Elon Musk would have been probably the last person I would have ever guessed to put this on the balance sheet, simply because he doesn't have the disposable free cash flows in order to sustain it. He's going to have to sell it if the timing's off or whatever, because he's not actually making money. Now, the company's changed a little bit since we recorded that, where I think they are free cash flow somewhat positive, but not all that much. And so it doesn't surprise me in the least bit that he has to basically fumble the football when you don't have the sustained income. You look at MicroStrategy. Every quarter, they're profitable with respect to the operational business of that company. Now, Michael has gone out and done, things that are levered. He's done it in a way that is not very interest bearing, right? Like, he locked in like really low interest rates with how he's choosing to use that leverage. But his company makes money. Operationally, they make money. And they consistently make, I would guess, like, I don't know, 80 million a year is what that company makes. And so when you're doing that, you can consistently allocate to it, and you aren't going to fumble the football by having to sell it because he keeps making money. through operations. And there's a big difference there. And it, like you said, Pierre, when you started us off, what happens at the individual level is also what happens at the corporate level, which is also what happens at the country level. So if you're a country that's a net producer and you're retaining savings in that country, well, you can be a country that actually acquires Bitcoin. But if you're a net consumer, it's going to be really difficult for you to hold on. At least you might be able to acquire it by debasing your currency and all this other stuff. But if that net consumption continues to persist, that Bitcoin will flow out of your treasury. It's just how it works. And that's why it's the fairest money that's out there, is because that's how things work.
Yeah, the contrast between Elon Musk and Michael Saylor to me is like the perfect comparison, because on paper you might think, oh well, Michael Saylor MicroStrategy is the one that's over allocated. Just looking at the balance sheet.
Yeah.
But then if you look at the statement of cash flows and income statement, that flips it on its head of, okay, he's actually going to be able to withstand volatility.
Yeah, I mean, the same goes on the individual level, right? Like the more stable your income is, the more stable your job is, the more wealth you generally have, right? The more you have that you can allocate to an asset like Bitcoin. And so I think if you take things, right, just like you were saying, all the way down to the individual level and then all the way back up to the largest thing possible, I mean, the same principles apply every single time. They're just in different situations.
Bitcoin is for net producers. It's that simple. If you're a net producer and not a net consumer, you can amass and accumulate Bitcoin. But if you're a net consumer consistently over and over again, there's no way you can continue to hold it into your personal treasury. It's that simple.
Yeah. I just want to add one other thing. I mean, as far as rule of thumbs are concerned, I mean, we have generally seen that allocations for people who want to hold a lot of Bitcoin, we're not talking about, Molly Sue down the block who just got interested in Bitcoin and she should only put, 3% of her net worth in. We're talking about, Bitcoiners who've really, dug deep, read lots of content. And this is the thing for them. We've seen that, and it's anecdotal evidence, obviously, from my small client base, but for the most part, people allocating somewhere between 40 and 50% of their net worth is something that's actually very sustainable, because you don't need most of your, you don't need basically half your net worth at any given period of time. And so you can withstand the volatility, assuming that you have the risk tolerance to do so, and you have the long time horizon, because you don't need that portion of your net worth and so forth. And so I think that if Bitcoiners are trying to think of a rule of thumb, that maybe that's a number that they want to stick around.
Yeah, I lost my thought.
I'm sorry.
No, you're fine. Do we have any other thoughts on allocation? No. Okay, so, gosh, we're gonna edit this out, but I had a thought about net producers. Yeah. So I think that a lot of people, like, coming into Bitcoin from the fiat world, are net consumers, and they immediately look at Bitcoin through that lens of, okay, I'm living paycheck to paycheck, or accumulating credit card debt. How does Bitcoin help me? How does what do I spend my Bitcoin on?
Yeah.
Is like their immediate question. When really it's like, okay, you don't have a concept of savings. So it's going to be very hard for you to understand that this is going to solve a problem in your financial world.
Yeah, you had a good point, though. If you want to tell the audience about it, it was related to why Bitcoin does help the people who are living paycheck to paycheck.
Yeah, so this has to do with kind of when we look at high net worth individuals, they put their wealth into financial assets, into real estate, into collectibles. And so when you look at their balance sheet, typically like actual cash that's not earning any interest, like actual dollar bills, or a checking account with 0%, it's going to be a tiny percentage of their net worth. Somebody living paycheck to paycheck, that means that on average, right, like 50% of their paycheck is in 0% interest checking account or their wallet, and that's their whole net worth, because they're paying rent.
Yeah.
They have maybe they have a little bit of equity in their car, maybe they have a big screen TV, but that means that inflation is going to hit that person a lot harder than somebody who's high net worth. And even if they were the same, the high net worth individual would not even feel a drop of 2% of their net worth. Whereas somebody who's living paycheck to paycheck, that means they can buy 2% less. And so that was that. I think the balance sheet question of who gets harmed the most on a relative basis by inflation.
Yeah, and I think if it's possible for that person who's living paycheck to paycheck to save even $5 a week in Bitcoin, they're going to be better off than saving $5 in fiat.
Yeah.
Assuming obviously they don't need that $5 a week
Yeah.
that you're putting in there. But yeah.
I really like Michael gets into from an engineering standpoint. And so if you think of like a capacitor, so a capacitor, you just put energy into it and then it can discharge it like almost like a battery, right? And when you think about like the most efficient capacitor you could ever make is you could put the energy into it and then it just continues to stay there and there's not a loss that when you come back in 4 hours, it's half as much. So when people were thinking about Bitcoin, so like you're performing this work, you're performing this energy that you're putting into this system. And when you store that in Bitcoin, there's like perfect, there's no line loss. There's no loss of that capacitor leaking out. And so when we look at this net consumer versus net producer situation, the net producer has excess energy to put into the capacitor. The net consumer literally can't even put any energy into the capacitor for it to even perform its function. So that's why, I agree with you. If a person does have $5 of disposable income to save, then it's going to be more beneficial for them than the existing system. It works, but I would argue that person saving such a small amount is pretty much at par with somebody who's not even able to save in the first place. But it's an important idea that, because when we think about fiat, like fiat is incentivizing people to spend as fast as they possibly can. Because when we go back to the capacitor example, it is, as soon as you put the energy into it, it's literally just like it's throttling down to zero in the blink of an eye based on the current fiat system. So if a person's looking at that and they're saying, well, I'm not going to put my money into this thing that just immediately goes to zero, I might as well go out there and spend it on something tangible immediately, because putting it into any type of savings, I just get rug pulled every single time. So you create this incentive structure where people will borrow, because now you're also incentivized to borrow, especially when the rates were really low. It's changed a little bit in the last couple of years, but when the rates were really low, now you're incentivized to go borrow other people's money because it's the line loss, and that is so significant. But what happens with all that is they get over indebted, even with the interest rates being extremely low. And now you're in this perpetual situation that you can never overcome. Like your head is so far below the water level that you're never going to make it back out. And so it's all a function of the fiat incentive structure that people, so many of the population, like a majority of that population, is in that boat of being a net consumer, and they don't even have the opportunity to leverage in Bitcoin's potential for them in their lives.
Yeah, and that's where I really see the value of the, like, putting $5 in, is that it's not that you're going to get rich off of $5 worth of Bitcoin, buying that today. In my mind, it's about breaking that habit. It's about, okay, now you've changed gears from being in kind of the fiat mindset to starting to be in that Bitcoin mindset of, okay, how do I create more value? How do I spend less? And so, that $5, every 2 weeks will grow to $10 every 2 weeks, and so on and so forth. And then you've got a nice nest egg of savings. And now you can, put that to, okay, 20 years later, I can buy the house I wanted or whatever.
Yeah.
I would say too that people tend to overestimate how much they make and underestimate how much they spend, and overestimate therefore how much they save. And so it's actually an exercise. We don't do it as much because honestly it's just mean to do this to people. But you ask them literally like, how much do you think you make? Okay, we put it down. And then you have them tell you how much they spend in each category. You estimate out for them taxes and you show them their net. And then you actually go through it. And if you if you compare side by side, the W-2 versus what they say they're making,
Yeah.
W-2 is always lower. The after tax income's always lower. People don't really realize, you're told I make $100,000 a year as salary. You don't necessarily take into account all the taxes you're paying, Social Security that you have to pay, benefits that maybe your company is immediately taking out, any money they were hopefully saving into a 401k, right? Like people don't account for that and they don't think about it when they actually get their paycheck. And so, and then on the other side, right, if you're something where you only have to really think about one number, which is income, right? Whereas with the expenses, you have to think about many different numbers. If you're having a hard time estimating income, which is a number usually people have told you, then you can imagine how widely off people are when it comes to the expense line. And then obviously, I mean, I can't believe I have to tell this to people, but I often do. It's like, you have income, and then if you spend less than you make, you have something called savings. And then you can do something with savings, and so from there it's like, obviously, how much that savings is going to, materially affect your net worth and so forth. But just starting at the basic equation for a lot of people is really difficult.
Yeah, there's the mental accounting, and then there's kind of the fictitious accounting of like people looking at paper gains, or people looking at their brokerage account and kind of looking at that balance as a cash balance, not as a, hey, this is the current market value of these securities that have gone up, but could go down.
Yep.
And people don't like to look at annualized returns. They like to look at the total return number in their brokerage account. So it's like they bought, I don't know, some stock 20 years ago and it's up 7%. Like that's not a good return, right? You're up 7%, great, but you did it over 20 years.
You don't want to show them that in comparison to just like an S&P 500 annualized compound annual growth rate. Because my experience when you do that comparison is most underperform just a basic index. Like they can't even, not even talking about some of the indexes that are better performers over a long period of time. Just like take the S&P 500 and most are not outperforming it. But yeah.
All right. So I know that we mentioned interest rates earlier. And I think at this point, like a mortgage is like 7%.
Yeah.
And I know, like from my own personal experience, it's like, okay, well, if I have a lower interest rate than what is the current interest rate, I don't want to move.
Yeah. Oh,
I
yeah.
want to stay put. It's like rent control, basically. And it seems to be messing up the real estate market.
Yeah.
But I don't know, where do you think this is heading?
Well, if we do get some interest, we're recording this in 2023, in August, if we do get a little bit of relief in the interest rate market, it's obviously going to help the prices of the homes out and not having this downward pressure being put on the housing. But I think in I'm looking at it from a long tail, right? I think in 5 to 10 years, I don't think that these rates are going anywhere. If they are going lower, it's going to be through some type of government subsidy that's like yield curve control that's going to force it to be lower than where it's at, because I think 5 to 10 years, it's going to be that, if not more. And if that's the case, all of a sudden it's really expensive to build a home of comparable value from, the 2020 timeframe. And, you're going to lock up. People are not going to want to move, the ones that were able to lock in those lower rates. Because if they are forced to move for work or whatever, they're gonna have a much lower quality of living conditions as far as what they can actually afford, because it's not a hard calculation. It's just a net present value of all those interest payments combined with the principal. And, you can figure out real fast that like a house at those lower rates versus where they're at now is like twice as much when you do the net present value. So, yeah, I think it's very concerning. I think we're starting to see some of that manifest itself right now in the commercial real estate market. I think that, the work from home stuff has really changed too since 2020, where a lot of, businesses are allowing people. So like they're not as fully, the vacancies are very high compared to what they were before. But I know I've seen some stuff in some of the major cities that are down 75, 80% in the commercial real estate market here in the summer of 2023. So I can only imagine what that's going to look like if the rates continue to be persistent, which it appears that they're going to be in through the end of the year. So yeah, very concerning.
Yeah, and I see kind of, well, let's see, we got a camera glitch here. Okay. I think there's like two impacts on Bitcoin. One is people use real estate as a savings account,
Yes.
basically,
Yes.
right? As a store of value asset. And then two is that the whole fiat financial system uses real estate as collateral. And we saw with Silicon Valley Bank using treasuries as collateral, they had problems. A lot of these banks are sitting on portfolios of real estate that could get shaky and impact
Yes.
the banking system.
Well, it's all fractional reserve banking. And when you look at what fractional reserve banking is you just got like a small amount of like actual monetary baseline units, and then you have all this credit constructed on top of it. And whenever you start to get impairment, Ray Dalio likes to use the term beautiful deleveraging, but I would phrase that as a catastrophic impairment and counterparty that gets, punched in the face. That's what deleveraging really is. When you're restructuring debt because of the impairment, there's one of two parties that are getting destroyed and wrecked on behalf of the other one getting away with, the murder effectively, where it'd be like you and me entering into an agreement and I'm saying, oh, I'm going to give you the $100 back. Oh, sorry, I only have 50, Pierre. Can you settle for the 50? And you're like, well, I guess it's 50 or nothing, right? That's Ray Dalio's beautiful deleveraging, that the government steps in and they're doing all these funky things to screw over one of the two parties in a debt deal. And so I really dislike that, the phraseology of that, because I think it washes away the reality of impairment, and it washes away this idea that in the fractional reserve system, one of two parties is really getting screwed royally. Yeah, I think there's going to be, that's just how the system is engineered, and it's how it's set up is for this type of expansion of monetary units through credit that is never ending until something comes and pegs it, which, that's why we're talking about Bitcoin.
Right. The other thing though is that they say that like you'll have this deleveraging where the other party in the contract will be impacted, but then they bail them out by printing money, and so all of society becomes a part of that contract, right?
Yes.
Yes. Okay. Well, now everyone's getting diluted.
Yeah.
I'm curious your thoughts on what you think is going to happen in the municipalities who, they issue this debt and then they would have to roll it. And obviously a lot of people issue debt at much lower interest rates. And then now if there are issues with maybe building new homes that would add to property tax values or add to property tax revenues for the county and so forth, like how that's going to affect the municipality's ability to basically do what they need to do.
You're already starting to see some of it play out in some of these cities, where the crime's out of control, they're so over levered. And so then what are they doing? They're going to the state level and they're saying, hey, we need assistance, or we need this is really bad for your politics. So you got to come in here and help this particular city, which is aligned with the state level politics or whatever the case might be. And if they can't get it at the state level, then they're going to the federal level, and they're trying to use those same tactics of like, we're this political party and the next echelon or the second echelon higher is of a similar political party. And we're wanting to get assistance with all this leverage that we've baked into our system. Since they don't control the currency, as you guys well know, like you are in a very bad situation for many of these municipalities that have completely just run amok with no sensible, they're not doing the math, Pierre. they're not doing the math. And it's almost like they've been to the point where, okay, well, there's no way we can actually recover from this. So we might as well just double down and get everything we can take, we're going to take by just doubling down on these horrible policies. And since they don't print the currency, it's just they're going to force the majority of others to come in and bail them out. And it goes back to my hatred of this term, beautiful deleveraging, because that's, again, they're going to go and renegotiate the terms. One of two parties is going to totally get screwed, and it might be the whole state, it might be at the federal level, but they're going to wash it away by other people paying that bill, and then other people getting off scot-free for their poor decision making and antics that they're doing.
And a lot of these are tax advantaged, right?
Mm-hmm. Oh yeah, people buy them specifically so that they don't have to pay federal income taxes on it. And then if you own the bonds of your state, you also don't have to pay state income tax on it. And if you own Puerto Rico, you get like everything free. So people love to buy Puerto Rico, but I don't know if you remember this. I think was it 2013 or 2012 that they had that crisis in Puerto Rico, where basically it's exactly what you're talking about. Puerto Rico, they just because of the triple taxation free thing that they had organized with the federal government, people were going into these bonds. High net worth investors were buying these for the taxation purpose, or to get out of taxation. And because interest rates were so low, like it was one of the only places where you can get some yield, because Puerto Rico is obviously a worse credit than, let's say, Austin, Texas or something like that. So, yeah. And then these bonds, some of them were trading, 30, 40, 50 cents on the dollar, because they just started, randomly spending money on everything that they could in Puerto Rico, because they were able to get the cash inflows, but they weren't able to actually service the debt.
You're seeing, I've noticed a social shift since COVID where, you saw the song, this country song that this guy just came out with. I forget this something. What was the name?
Rich Men of
North of Virginia. Yeah. And it's an example of the trust is completely eroding. People can't define why, but they can define the money's broke. They're doing these things on Pedo Island, and like the whole elite, like all this stuff, like everything is the trust is eroding throughout society. People don't really kind of understand the critical variable that's far enough upstream that's really the root cause of it all. It's the money, that it's not pegged, and that you have a couple people in a room kind of pulling these strings, and it's like, hey, Pierre, you sit right next to the money printer, so you get the first dibs on the next billion that we print, right? That is the issue. People can't see it, like exactly what's causing it or what that critical variable is, but they can sure as heck feel it. They're writing songs about it. Everybody in the country, literally #1 song. This guy was a nobody, but he wrote a song that empathized with how everybody feels right now. And it's just getting started, right? This is just starting to warm up. And what I think everybody's going to come to the conclusion, with enough time and enough debasement and enough shenanigans that many of these G7 leaders are playing, is everybody's going to come to this realization, oh my God, it was the money all along. That's why we had Clown World. It was the money that was causing it. And, it's crazy.
So we get serious world with Bitcoin? Is that what you're saying?
I don't think that the Clown World meme is about the entertainment value.
I know.
Alone. I hope.
I hope not. I hope the entertainment doesn't go away.
Yeah.
Well, maybe some of it. the bad entertainment that makes bad things happen to people that are good.
Yeah, I don't know what folks are going to be complaining about
Under a Bitcoin standard.
I would define Clown World as just the worst decision you could make seems to be the exact decision that's being made.
Yeah.
Right. That's Clown World to me, is like, well, of course the person did that, because that would probably be the worst thing that they could have chosen out of 3 courses of action. They chose the worst one. Like, that's Clown World. It just seems like everything is incentivized for people to make the worst possible choices and decisions that they can. And it's again, it's the fiat incentive structure that's driving all of this, in my humble opinion.
To me, clown world is they're lying to you. They know they're lying to you. They know you know that they're lying to you.
Yes, yes.
Like,
About
just
pretending.
yeah. And I'm just pulling my hair out.
I do like the idea though of like good decision world. That sounds like a good place to be. Yeah.
Yeah. Agree. Honesty.
Honestly.
Yeah. Yeah, the politics are getting polarized. I mean, especially going into an election cycle. Like, I know the presidential debate is tonight, and so it's really about people fighting over who controls the money printer, and that's just going to amplify.
For sure.
Okay, so let's bring it back to Bitcoin world. People are going to be talking about the election, but we're going to be talking about the halving.
Yeah.
The halving is next year. Preston, what are your thoughts on the halving at this point?
I've this past cycle, I think, has made everybody question the 4-year cycle. And I'm still a pretty big proponent of the 4-year cycle. I think that when we look back at this 4-year cycle that kicked off in 2020, I think looking back, we're going to say we had some really bad actors with significant influence in the market. Sam obviously being one of the main instigators. I think that when you maybe CZ and Binance, I don't know, it's going to be interesting to see what shakes out there. Three Arrows Capital, like these people were controlling a massive amount of buying power in the Bitcoin ecosystem, and then all the crypto coins at large. And I want to, when you look at when these things fail throughout history, what society has demonstrated time and time again is speculation becomes paramount, because nobody has retained earnings. Nobody has excess, capacity to save. They're forced into this environment that they've got to speculate to try to get ahead. And there's no better demonstration of that than JPEGs and like these coins of like nothingness, right? It is the definition of clown world, clown coins, and just speculation at large. Is people just, they know it's a scam. They don't care it's a scam. They just want to buy it and then sell it for 10 times more 3 days later so that they can go out and go on a vacation or do something that they're just immediately going to spend whatever gain they were able to nab and extract out of this clown market. So I think we should expect more of that, because I don't think we're at peak clown world yet. I think peak clown world is still to the right in the timeline. And I know this was about the 4-year cycle. But yeah, so when I look at this past 4-year cycle, I would define it as a bunch of bad actors. Speculation is picking up, but when I look at the next 4-year cycle, I guess maybe this is just me being an optimist kind of coming out. I think that it's going to be very different than the one we're going through right now. I think this one that we're going through right now has been very difficult. If somebody's entered Bitcoin for the first time in this 4-year cycle we're at right now, I think they have had one of the most difficult cycles to participate in relative to the ones that we've experienced before that. But I think the one that's coming up is going to be pretty exciting, to say the least. And you're also getting this situation where I think all the clown coins and JPEGs and all that stuff got so out of control, and FTX just made all these regulators look like such idiots that it's almost like they've whipsawed the other way, and that they're now overextending and it's getting, I'm not going to go down the path of what's right or wrong in that regard, but I think you're going to have much more responsible actors kind of step in to to participate in Bitcoin, and a lot of the scammy type stuff is going to be just a lot different than what we've experienced in this cycle right now.
Yeah, a headline I saw today was that Coinbase is delisting some assets. So it reminded me of when I worked at Kraken. There were two big, kind of clown coins. One was SHIB, so there was the SHIB army, and then the second was Terra Luna. That triggered the theory, Arrows Capital, and all of that credit complex. Going outside of the crypto universe, I think that another part of it was this conversation around, and we brought it up earlier, inflation hedge. And I think that, I think Bitcoin marches to its own beat, and Bitcoiners or Bitcoin, the mind share isn't looking at CPI prints and trading based off of that. And what they're trading off is, how will the Federal Reserve react to the CPI print?
Mm-hmm.
And if I look at a chart comparing the 2013 cycle to the 2017 cycle to the 2021 cycle, there's a noticeable break in the kind of, okay, they look alike, when Larry Summers comes out and says, hey, look, inflation's not transitory, and we need to be careful about fiscal policy and monetary policy.
Mm-hmm.
And that was very unpopular at the time. People were saying, oh, Larry Summers is becoming, a hawk. And and
on
so
his way to Bitcoin maximalism.
Yeah. Well, yeah, maybe we should bring him in for an interview for a podcast about what his thoughts. And so that's when then there was a very long period of time of, I think, political delay of, okay, we're not going to tighten right now. Let's keep it loose, for the midterms. And then, but Bitcoin reacted of like, okay, at some point interest rates are going to go up. And so Bitcoin topped at that point and did not go, to the laserized 100,000 that everyone was
thinking. Yeah. I think a little bit of it is you have people that are owning Bitcoin, but they also have a lot of other assets that they own, and they're not just like Bitcoin only. And because of that, and because there's such a large number of people that are in that situation, when they start getting impaired or the values going down in these other assets that they own, they become forced sellers of Bitcoin, and to offset some of that, fractional reserve, going back to the fractional reserve again, you become forced sellers. And I think that's why you're starting to see some of the correlation that we've seen in this past 4-year cycle with risk on assets. I think it's Greg Foss keeps saying that this is not to be correlated with equities at a certain point. And when that realization actually hits, because there's, the people that are in that situation where they own equities and they own Bitcoin and they're becoming forced sellers of Bitcoin, once they get washed out with enough time in these cycles, and that the really hardcore, I only own Bitcoin people that buy it, put it in a cold storage, never to go back on the market again, as they continue to accumulate and you start to get this saturation point, that's when you're going to see a break from equity markets and risk on assets. And I think that moment in time, whenever that eventually does happen, and I think it's going to happen here in the coming cycle, I think it's going to be a watershed moment that makes some people's hair really kind of blow back, like, what in the world is this and what is happening? I thought there was a chance it could happen this cycle, but and I think we talked about that back maybe 2019, 2020. I thought there might be a potential that could happen this cycle, but I really think it's going to happen on the coming cycle, especially with BlackRock and all these others that are, I think, going to enter this space very heavily in the coming cycle.
I'm not sure if it's this cycle or next cycle, but what I'm seeing is that Bitcoin doesn't go away, right? And people are noticing that. And so from a financial advisor's perspective, just seeing what the other financial advisors are doing in this space is kind of indicative of like what retail in general, I think, is viewing about Bitcoin. And so like when I first started advising on it, there were literally only 2 clients out of my entire client base that were interested in 2016. In 2017, because of that big run up, I had questions about it, but people weren't serious. They didn't actually
Yeah.
want to allocate. Only 1 or 2 actually allocated then. And then when it didn't go to 0 in 2018, I had more people be like, "Hey, this is kind of interesting. Like maybe I should allocate." And so we had a few more people in 2018. In 2020, like we started trying to have more conversations between 2018 and 2020, trying to get people interested. We were able to get some more people interested, but it wasn't like it's that run up that really does get people interested. And so the conversations I have with financial advisors are kind of the same thing, right? They're starting to see, hey, like this is something clients are asking about. It's something I need to know about, but this is a scam. I'm not going to get my clients invested in this. And it goes from being something that's a scam or a tulip bubble or whatever they want to call it to like, okay, well, it's still here. So maybe it's not that. Maybe it's not like the best asset to own, but it's certainly not the worst thing to own. And so you're just sort of slowly seeing people like dip their foot in and get their ankle wet and get their knee wet, until they're finally like, fully like Preston over here, orange pilled and, podcasting about it for a decade. But, obviously most financial advisors aren't going to be that way, but I think it's sort of indicative of how slowly people move in general and how long it takes people to go. And so if you think about how long Bitcoin's been around, right? The white paper was written in 2008, right? So, I mean, we're talking about 15 years now, basically since its creation. And so the longer it's around, the more people are going to look to it as something that they should invest in. So whether it's this upcoming cycle or maybe the next one is the one where, okay, wow, I mean, this thing's been around for 20 years now. Like this is crazy. I really do need to be involved. Like that's kind of where I see the halving going.
I think there's something really cognitively that's going to happen for people when it gets into 6 figures. When it's like the value of a house, right? I think people are going to be forced to say, all right, there's no way people are dumb enough to have one of these imaginary magic internet money coins that's worth like a house. There's something I'm missing. At that point, I think they truly have to deal with the reality that, no, I think it's me that, because I've watched this thing, I've watched it die for a decade now. It keeps coming back and it keeps coming back at a higher number. And now it's like the value of like a house. Like, what is it that I'm missing? I think there's just something really unique about the 6 figure, the 100,000 mark and beyond that I think is going to force people to dig a lot deeper than they ever have on what it is.
Yeah, I mean, something we are talking to clients about, at least not like the Bitcoiner clients who've come in, because obviously they've already realized this, but for my clients who came on before I was even pitching Bitcoin as something that they should own, we're talking about the fact that like the hope is that they don't ever convert that back to fiat, right? That they have this in their portfolio and it's something that they use in retirement. And that's a foreign concept to a lot of people, that they're not going to be using the US dollar in the future. We just had a conversation with a client. They want to invest in a private investment and sell some of their Bitcoin because they've held it for a long time and use that. And it's like, no, like leave your Bitcoin stash alone. Like, let's use some of the other fiat that we haven't allocated to buy this thing, just because like we're looking to use this in 20 years. We're not looking to convert back. And I think that's really, for most people is a complete, you can't wrap your mind around it because, first of all, especially like people's first thought is the volatility immediately. Like, how can I possibly use something as volatile as this as my day-to-day money? And we actually had a good podcast episode about that. So I invite people to listen to Bitcoin for Advisors about that.
Hey, you can't shill your podcast on the Riot podcast. You have Preston shilling his podcast. Bitcoin for Advisors is a great podcast. So is noted.
It's hosted by Morgen Rochard. Works at Riot. It's not like it's a tangential shill.
Morgan has an excellent book out. You can find it on Amazon. It's got 4.5 stars. Yeah. So yeah, I think that there's that, and then we're going to be in a different part of the monetary cycle. And by all indications, it seems like we're reaching the top of the rate hiking cycle. And if Paul Krugman gets his way of raising the inflation target to 3%, I think we might see a rate cut soon. But where do you think rates are going to go this year?
For me, I'm watching oil really closely. I think that, it's such a primary input to everything is just the energy input. And, the US government stepped in pretty aggressively with the release of the SPR for what seemed like about a year. And they were able to kind of keep the oil price down. But if that starts to run away, and I don't know which way it's going to go, but I will say this, the momentum is kind of looking like it's about to shift back into a bull market. And if that's the case, I don't know, you might see a little bit of a resurgence in inflation. And if that happens, I think they're going to be a little worried to maybe slow things down on the interest rate hikes. They'll just keep raising because they've got to try to get some of this under control. So I would say that's the direction I'm leaning. That's what I would think is maybe going to happen into the close, is that you might actually see a little bit of a resurgence in inflation. I know diesel prices, gas prices over in Europe and especially in the UK they're coming up pretty aggressively. And I mean, that's a huge input to manufacturing and everything in the world. So I'm watching that. Now, on the flip side, like if I was going to argue with myself, there's a lot of talk that there's a pretty significant slowdown in China. When you're looking at the import numbers from other countries, Korea and whatnot, they're down 20% from where they were the year before. So maybe we're already starting to see a slowdown in China, and maybe that's the driving factor. I personally, if I was going to encourage people to look at a chart, I personally like to look at the 3-month minus the 30-year to kind of see the credit cycles. And I would just tell you, when you're looking at the volatility of that, it really hasn't demonstrated that there's been a shift yet, which means we haven't kind of hit the turning point yet, but we could maybe be there pretty soon. But yeah, I mean, and here's the thing is, like, once that particular chart bottoms, you have about 600 days from that bottoming to what has historically been a bottom in the equity markets. So we haven't even hit that yet. So let's just say that we hit that today. We're basically 2 years. So like 2025 for a bottoming in the equity markets, if that was happening right now. And I don't even know that we've hit that trigger yet. So I guess when I'm looking at that, and this is where I think Bitcoin really kind of does start to be very independent from risk on assets, is we're in this completely different like timeline where I would argue we've had aggressive selling for the last year and a half. A lot of that with Sam basically selling all the customers' deposits into the market. And then whatever's happening with Binance right now, I have no idea where that ends. But I think kind of at the end of this year, going into the halving event, we're going to have so much selling suffocation in the market that it's going to be really hard to kind of keep Bitcoin suppressed going into, call it 2024, 2025, in the face of what I would say is going to be a lot of struggle for risk on assets in 24 to 25. So, yeah.
Yeah, it does kind of seem unrealistic to think that if Bitcoin's going to go back to 17K where it was, 6 months ago, except in the case of like a flash crash from some kind of credit event is going on. But I think that the sellers are exhausted, which is not the case in equities. Right?
No, not at all. Yeah,
Nvidia.
Yeah, I think in the equity market, I think you've had a pretty well, let me say this. This is the one counter argument that I would have. I'm not putting a lot of weight in this, but if you have this idea in fixed income that they're not going to be able to get inflation under control, and that people are expecting, call it double-digit inflation, based on all the trillions of monetary units that they're going to have to add into the system from like an M2 standpoint in the coming 5 years. If the fixed income market is expecting that, it's going to continue to sell off. And if it continues to sell off, that buying power has to go somewhere. And so where does it go? It goes into really high quality cash producing, free cash flow producing equity. I think it's going to go into the really high market cap equity that's like really got a massive competitive moat. And so those are the equities that are driving the indices, is these really high cap companies. So like if you're looking at a Dow Jones index, like, hey, maybe it performs pretty well in the face of like what's about to play out, which would be very different than anything we've seen in our lifetimes. So there's a potential for that. You know, that's the terrible part of like anybody listening to like find, like, you have to be able to argue both sides of like what could happen. And then it really kind of comes down to the probabilities that you assign to this array of potential things that could happen. Right. And as the environmental factors continue to change and you start to get cueing that, well, it's looking like scenario 1 and not scenario 2, well, then you got to shift and kind of like pile into that position. But if it's looking like the other, well, then you have to be able to kind of adapt and kind of go in a direction that maybe you weren't expecting, but the price action is telling you actually your second thesis, which you were having a lower probability, is the one that's playing out, and then start researching more and kind of going down that path. So, yeah, I think for somebody who's listening to all of that and maybe they're not into finance, or they're not like, you know, doing any of that type of stuff professionally, they might think that people are just talking out of both sides of their mouth. But I would tell you that some of the best financial minds I've ever studied are investors that literally can just lay out their opinion, and then they can lay out their counter opinion just as strongly as they just laid out their opinion, right? And they are Stan Druckenmiller, probably one of the best in the world at like, this is my opinion today, but I might actually take a short on that position tomorrow if I get a new news feed that gave me a bit of information that caused me to change my mind. He takes great pride in changing his mind. And I think you have to be a great investor and somebody who really kind of protects themselves in finance and investing, you have to be willing to be able to change your mind. And where human nature is to look at changing your mind is a very bad thing. It's consistency bias. Robert Cialdini talks about it in one of his books. I can't remember which one. I think it's Influences. I think the book that he talks about it. But this consistency bias, people feel that they're being judged socially by being flippant in their opinion, like, hey, let's go to lunch. No, let's not go to lunch. When a person is like that, they're viewed in a negative lens socially because they look like they can't make up their mind and they can't ever like really decide on something. But I would argue that in finance, you've got to really kind of wear it almost as a badge of honor that you're willing to change your mind and that you're willing to listen to environmental factors. But there has to be a lot of research and rigor behind why you're changing your opinion that might have already be preemptively researched and decided upon, that if A, B, and C get triggered, then I'm going to go in this direction instead of the one that I had originally thought. But
so for those of us who don't have the emotional maturity to do what Preston did, or have too big of an ego, and maybe that's me, but okay, how do I absorb this information? And for me, it's like, okay, the way I do it is like, in my mind, the disclosure of, hey, look, this is not investment advice. This is just for entertainment purposes. I do take that seriously because I don't act on anything. Like, you know, if I'm reading the news and I change my mind, first of all, I'd have to go to Morgan and be like, I need you to put in a trade. And then she'd give me a look of like,
hold on a second.
Yeah.
Why are you wasting my time?
Yeah. True, actually.
That's what stops me from changing my mind is the financial planner in life. But no, I think that like
you got to have a plan and you got to stick to the plan, right? To a certain extent, but you also have to define and you got to try to do it as best you can. That, all right, so I just described what I think can happen in equities. I've given you a bull case where I think some of the large cap equities could actually continue to be quite bullish in the coming 2 to 3 years. But my base case is that they're going to continue to follow the track record that we've seen over the last 40 years, which is as the credit event starts to play out, which I expect to play out in the coming 2 years, equities will get punished over that period of time. That's my base case. But if it doesn't, I also have the list of the reasons why that wouldn't play out. And so I sit back and I'm letting the market demonstrate to me through watching the price action. And, I mix value investing with momentum investing, and everybody's got to kind of find the way that they invest and what rules that they're using in order to make their decision-making, right? And most people just need to buy an index and dollar cost average. I'm sorry, but but for the people that are people that are trying to
We'll let Morgan talk about that.
yeah. But for people that are truly trying to outperform major indexes, I think that you really got to study the people that have consistently been able to do that for more than a decade, but preferably 2 to 3 decades that have done that. Read what they say about how they think they did it. Because some of it, they might think that they know why, right? And just have a deep appreciation for you can be very wrong. And so, and I know some of this has gotten away from just Bitcoin in general, but just like financial investing. And I mean, that's what our show is all about, is just studying the greats and what people say about how they were able to do it. And like, these are some of the core ideas that they talk about all the time is being able to set out a path, set milestones of what would be indicators as to, well, it's my first thesis, not my second thesis. Here's the reasons why, and then being able to act on changes as you go.
Yeah. And so for me, it's like, if I look at, okay, 50% chance it's going to be bullish, 50% chance it's going to be bearish.
Mm-hmm.
In my mind, it's like, okay, how do I have a financial position where either outcome is good for me, or
without paying a tax for when I say pay a tax, like you're buying insurance through options, right? Whoops, got the.
Yeah.
I call it an insurance package. I know the audio is still working.
Yeah.
But basically, like, how do I hedge myself through options to protect myself that if it's this one or that one, that I'm right no matter what? I'm sorry, it just doesn't work that way. Like, you're going to pay a tax for that dual position, and you're going to do it through the fees of doing that type of action. So I would just tell you, if you're 50-50 in something, like, how you protect yourself is by not taking a large position size in that, and you go out somewhere else in the financial markets to find something that you think is more like an 80-20 thesis that's going to play out. When you're looking at something, you're saying, I think it's 50-50, you probably need to have a very small position size in that particular thing. Like for Bitcoin, I have a very strong conviction that Bitcoin is going to crush it in the coming 10 years. And therefore I have an outsized portfolio positioning size on that, because I have so much confidence built into that. And I feel like I have it backed up with a whole lot of intellectual rigor to continue to provide checkpoints for myself as we continue to march right on the timeline.
Yeah, I'd like to emphasize what you said about long-term perspective here, because I think as people hear what you're saying, they're hoping to be like Preston Pysh and like, Stanley Druckenmiller and be the next best investor. And for most people, even if you could be that person, for most people, right, it's not going to make sense based on the amount of time, energy, and money you have to put towards it. Like if you're a dentist or someone who runs a candle store and you're really good at that and it provides a lot of value in your life, right? Maybe you don't want to be spending all of your other waking hours thinking about, the 80-20 probabilities of whether or not a specific stock is going to work out and what environment it's going to work out in and so forth. And that's just one position. In these people's portfolios, I mean, they've got hundreds of positions sometimes. And, maybe one of them dominates and, is like a 20 to 30% position, but they still have hundreds of others that have been researched. And so I feel like for the average person, it really does make sense to not be thinking about timing, because like maybe this credit event happens in the next 2 years, maybe it happens in the next 10 years, right? We don't really know, right? I think 10 years is probably maybe a stretch here, but like,
Unprecedented.
you know,
Yeah.
it might be unprecedented, but
It's
but
thanks to
frankly,
AI, right?
Yeah.
AI productivity, we're gonna have a crash again.
yes, that's fair. So you just don't really know necessarily how things are going to play out, and the more people have the same opinion, usually the less likely something like that happens over the time frame that people say that it's going to happen. And so for the average person, just buying and holding, whether it be Bitcoin or stocks or whatever it is that you're holding, hopefully not 30-year treasuries. If you're just going to hold it for a long period of time and not worry so much about the ins and outs, you're going to do better.
Yep.
I don't know if our
Nope.
camera's still not working. Or either one
It
of
did
them.
me a favor.
Yeah. Once it started hearing Preston talk about active management and trading, it was like, we don't do that. Okay, so
Cameras are long-term Bitcoin holders.
yeah, these cameras are quite an investment.
Yeah.
Well, thanks for coming on, Preston.
Thank you guys for having me. This was a blast.
I learned today that the cameras give up after an hour. So it's really good. We can't do Joe Rogan in here. We can't
No,
do the
no.
3.5 hours. But yeah, we're looking forward to hearing you speak at BitBlock Boom.
For sure.
Yeah, thanks again.
Thanks for having me, guys.
Thanks for having me too.
Oh yeah, and thank you, Morgan, for coming
It's not my podcast.
We'll have you back on.
Okay, great.
And we'll get more great personal finance tips from you.
Perfect. Thank you.